Imagine you are managing Uber's capital allocation. You have spent the last decade proving to institutional investors that you can build a multi-billion-dollar transportation empire without manufacturing a single car and without employing a single driver.
Right, proving that a transportation company could operate purely as a software business.
Exactly. And it worked. The structural model finally achieved profitability to the point where projected 2025 free cash flow sits at roughly $10 billion.
A massive shift from the early days of cash burn.
It is. But then you take that $10 billion and commit it to doing exactly what you promised you would never do. You bankroll the deployment of physical autonomous vehicles.
It is a profound contradiction on the surface. I mean, if you look at the balance sheet.
Right.
We are looking at a company that is finally highly cash generative, confronting a shift in technology that threatens to redistribute the economics of every trip.
Which is the core tension for investors.
Well, this $10 billion allocation is not a signal that the core ride-hailing business is failing. Look at the baseline financials. In the latest quarter, Uber generated $58 billion in gross bookings and $14.2 billion in revenue. Demand is strong, but management is executing a defensive maneuver.
Defensive against what, specifically?
Against obsolescence. They are allocating capital to ensure that robotaxis do not eventually render their core platform irrelevant.
That brings us to the operational strategy Uber is attempting to execute to protect those economics. They have chosen a path that relies heavily on what they call an asset-light directive. Uber has explicitly stated what it refuses to do.
Which is almost as important as what they're doing.
Precisely. It will not build the autonomous driving system internally, it will not become an automaker, and where possible, it will avoid owning the actual vehicles.
So they want to be the Expedia of self-driving cars, essentially.
That is the model. They do not want to own the hotels or fly the planes. They want other companies to build the car, develop the digital driver, and operate the physical charging infrastructure.
And Uber just controls the layer on top.
Right. Uber intends to control the specific layers that matter to them. The rider, the demand, the dispatch, the payment, and the vehicle utilization.
That assumes platform leverage holds indefinitely against the companies performing the actual engineering. And that is a position worth challenging from an investment standpoint.
You doubt they can maintain that control.
We have to ask whether a software platform can genuinely dictate the terms of autonomous transportation without owning the proprietary technology that actually drives the physical car. I mean, can you control the economics if you do not control the hardware and the autonomous stack?
To understand why that question dictates Uber's future, we need to compare the economics they enjoy today with the harsh realities of autonomous infrastructure.
The unit economics today are very favorable for the platform.
They are. Today, a conventional Uber driver supplies two things simultaneously: labor and capital. The human driver provides the vehicle. That driver absorbs the depreciation, the financing costs, the maintenance, the fuel, and importantly, the idle time risk.
If the car sits empty, the driver absorbs that financial loss, not the platform.
Correct. Uber simply supplies the marketplace to match that driver with a rider.
Well, look at the margin data first when considering this transition. There is a primary misconception in the robotaxi debate, which we can call the missing margin fallacy.
The assumption that the driver's cut just shifts over to Uber.
Yes. Investors often assume that removing the human driver means the driver's historical compensation drops straight to Uber's bottom line. But eliminating the driver does not eliminate the cost structure. The physical realities remain.
Right, because someone still has to purchase that vehicle.
Exactly. Someone finances it, someone insures it. The fare has to support an entirely different, highly rigid industrial system. You have an automaker. There's a separate autonomous software provider. There is a fleet owner.
And the physical footprint as well.
Yes, the depots, the charging infrastructure, the sensor calibration, the maintenance. Uber may control the transaction on the app, but those external businesses will expect substantial returns on the capital they deploy to replace the human driver.
Which shifts the critical question for anyone tracking this market. If you have taken an Uber recently, you know the prices have crept up, and you might be wondering if driverless cars will finally make a ride cheaper. The answer lies in determining the fully loaded cost of an autonomous mile.
And identifying who retains the bargaining power for whatever residual margin is left. That fully loaded cost is precisely why Uber's robotaxi strategy today looks entirely different from its first attempt at autonomy.
The realization of those heavy cost structures forced a total reversal in their corporate strategy over a 3-year period.
I mean, they completely abandoned building it themselves.
They did. Go back to 2020. Uber transferred their advanced technologies group to Aurora alongside a $400 million investment. They formally abandoned the internal development of a complete autonomous stack. They realized that building the complete driving system internally was an infinite capital sink.
So instead of internal development, they pivoted to marketplace aggregation. The strategy is no longer to own one autonomous stack. It is to build a marketplace where every autonomous stack needs access to Uber's demand.
And if you look at the portfolio they are constructing to execute this fragmented approach, it is a global deployment.
A very fragmented one.
Very. We have Waymo vehicles currently operating through Uber in Austin and Atlanta. Zoox is preparing its purpose-built robotaxis for Las Vegas and Los Angeles. Then there is NVIDIA.
Planning software-driven autonomous fleets across 28 cities by 2028.
Right. And Wayve is expanding internationally. WeRide is already providing fully driverless, paid rides through the app in Dubai. But wait, if Uber is actively trying to avoid owning the cars and the infrastructure, why are they suddenly exposing themselves to balance sheet risk?
You are referring to the capital commitments they are making to ensure fleet availability.
Yes, take the Rivian agreement. Uber has committed up to $1.25 billion through 2031, contingent on Rivian reaching specific autonomous performance milestones.
That is a significant hardware commitment.
It is. Under the structure, Uber or its fleet partners are expected to purchase 10,000 autonomous R2 vehicles initially, with an option for 40,000 more.
Which is where the concept of asset light begins to degrade. Uber may not be manufacturing the Rivian vehicles on an assembly line, but underwriting vehicle demand, financing technology partners, and supporting fleet deployment exposes them to substantially more capital risk than simply matching a passenger with a privately owned sedan.
It fundamentally changes the balance sheet.
You cannot call yourself purely a software aggregator when you are committing $1.25 billion to guarantee hardware availability.
And the Lucid Nuro structure goes even further in altering that traditional model. It is a multi-party operational puzzle. Lucid supplies the physical vehicle, Nuro supplies the level 4 autonomous software.
And Uber supplies the marketplace.
The marketplace and parts of the operating infrastructure for a target of at least 35,000 global vehicles over time. And it is not just the vehicles. In Houston, Uber has already secured a physical 50,000 square foot depot,
along with a separate charging location to support fleet operations.
How does a software platform justify leasing 50,000 square feet of industrial real estate?
Well, that physical depot is empirical evidence that requires close attention. It matters far more than a PR announcement or an autonomous driving demonstration. A 50,000 square foot depot is proof of where the underlying business model is shifting.
Ride-hailing historically outsourced the vehicle infrastructure to the driver's personal garage.
Now, robotaxi economics are pulling that physical infrastructure back onto the platform's balance sheet and toward its fleet partners. The software company is forced to touch real estate, charging hardware, mechanical repairs, and fleet management. We are witnessing the return of heavy capital expenditure to the ride-hailing model.
Uber packages this broader offering under the name Autonomous Solutions. The strategic pitch to these engineering companies is straightforward. You solve the incredibly difficult technical problem of building the autonomous driver, and we will help you commercialize it.
Basically saying, we will bring you the riders.
Exactly.
But that pitch depends entirely on the leverage of the autonomous partner. We must analyze the existential threat to Uber if a partner decides to internalize this physical footprint entirely. What happens when the company with the most reliable autonomous technology decides it simply does not need Uber to find passengers?
Waymo provides the clearest precedent for that threat.
The termination of the Phoenix partnership.
Right. The two companies terminated their limited Phoenix partnership in June. While Waymo vehicles do remain available through Uber in Austin and Atlanta, and management expects those relationships to continue, we have to look at the unverified Financial Times report.
The report that indicated Waymo has considered pursuing those markets independently when contractual terms allow.
Yes. If a partner can just walk away and launch their own app, it exposes a massive strategic weakness for the aggregator.
The monopoly threat here is structural. A vertically integrated robotaxi operator has the potential to own the entire value chain. They control the autonomous software, the physical vehicle, the fleet data, the rider experience, and the consumer app,
leaving Uber with nothing in that specific market.
If a competitor achieves sufficient vehicle density in a city and can fill enough of its own cars without relying on a third-party app, what exactly does Uber own that the autonomous operator cannot reproduce?
The macro answer to that is demand. and it acts as Uber's primary defense.
Correct. Demand and utilization. An autonomous vehicle is a fixed asset. Once it rolls off the assembly line, its economics depend heavily on keeping it productive.
Because fixed assets depreciate constantly.
A human driver can simply log off and go home during a Tuesday afternoon slump in demand. A fleet-owned robotaxi continues depreciating. It still occupies expensive real estate. It still requires insurance, scheduled maintenance, and financing payments.
Capital is tied up.
Idle time destroys fleet economics, whether somebody is riding in the vehicle or not.
That structural reality makes vehicle utilization the most important metric in this transition. Think about the mathematical problem a robotaxi company faces when entering a new city.
They need density.
They need enough vehicles on the road to offer a 3-minute wait time. But every additional vehicle they deploy increases the amount of capital exposed to periods of weak demand. If they build too few cars, riders cannot get one, and the consumer experience is ruined.
If they build too many, those $100,000 assets spend half the day parked, ruining the balance sheet. Uber argues that its existing aggregated demand can solve that utilization gap.
And Uber possesses a second structural advantage that standalone autonomous operators do not have. They can mix autonomous vehicles with human drivers on the same network.
This is hybrid liquidity.
Let us examine how hybrid liquidity actually functions in the real world. Think about what happens when a massive event, like a stadium concert, lets out.
A dedicated robotaxi fleet cannot handle a sudden, localized spike of 10,000 people needing rides in a 2-block radius.
The capital cost of keeping enough idle autonomous vehicles around just for peak surges would be catastrophic.
But Uber can instantly implement surge pricing and flood that specific area with human drivers. That hybrid network is a massive operational moat.
Robotaxis can handle the predictable high utilization routes, while human drivers absorb the demand spikes, handle the complicated edge cases, and cover the regulatory gaps.
It allows the platform to manage physical fleet capacity without overexposing capital to those unpredictable periods. That combination of hybrid supply may ultimately prove more important than the autonomous technology itself.
Because a standalone autonomous operator must size its physical fleet capacity around fluctuating demand.
Right. Uber utilizes its flexible human supply layer as the overflow mechanism. The transition to autonomous transportation does not have to be an abrupt binary switch. Both systems can coexist, providing a financial buffer for capital deployment.
We are already seeing evidence that autonomous companies recognize the value in testing both distribution models simultaneously.
The Zoox experiment is a good example of this.
It is the perfect example. Zoox is launching paid rides on its own direct-to-consumer service in Las Vegas while simultaneously partnering to offer rides through Uber.
It is a live experiment testing the central thesis of this entire industry. Will passengers choose to download and open a dedicated autonomous brand app? Or will they prefer one aggregated marketplace where human-driven cars, autonomous vehicles, and different price points all compete for the same trip?
If the autonomous brand wins that consumer behavior experiment, Uber is in trouble.
The strongest autonomous companies will keep the direct rider relationship and retain the majority of the underlying economics. Uber would be reduced to a secondary distribution channel rather than the indispensable gateway to the market.
But if autonomous supply fragments across many credible competing providers, the balance of power shifts decisively back to the platform.
Which explains why Uber is actively financing competitors to ensure no single autonomous provider ever achieves the density required to cut Uber out. They want fragmentation.
They are working with Rivian, Nuro, Wayve, WeRide, Zoox, and NVIDIA-powered systems.
If no single supplier achieves overwhelming fleet density, none of them can bypass Uber. Each provider has a mathematical reason to tap into Uber's aggregated demand rather than spend billions trying to build a separate consumer marketplace in every single city.
That is the strategic math of the density equation.
The number of technically successful autonomous systems matters directly to Uber's survival. One dominant autonomous provider is an existential threat. 10 competing providers structurally strengthen Uber's marketplace.
Uber does not need to own the winning autonomous technology, provided it can prevent any one technology from monopolizing autonomous supply.
If they're all competing against each other for utilization, none can afford to leave Uber's network.
That brings us back to the core capital allocation we started with, the $10 billion commitment. We can view a portion of that capital as offensive, expanding supply.
But the vast majority of it is defensive platform insurance. Uber is utilizing the massive cash flow generated by human drivers today to prevent tomorrow's capacity from being built outside their ecosystem,
Doing nothing would preserve free cash flow in the short run.
which certain institutional investors always prefer. But if autonomous fleets eventually become cheap and reliable enough to displace meaningful human-driven volume, Uber could wake up and find that the most important new supply was built entirely outside its network. They are allocating capital now to neutralize that possibility.
Let us shift to the operational reality and the actual stakeholder impact across the value chain. Who are the structural winners if this shift succeeds?
Well, autonomous developers gain immediate access to a global pool of customers.
Automakers gain guaranteed fleet demand. Companies like Rivian and Lucid are no longer relying solely on convincing individual consumers to buy their cars. Robotaxi programs transform them into suppliers for institutional buyers ordering tens of thousands of vehicles at a time.
And infrastructure operators gain prominence. The companies handling the charging networks, the real estate depots, and fleet maintenance. Ride-hailing shifts from a purely digital matching service back to a physically intensive industrial operation.
What about the consumer? Will fares actually drop?
Consumers could eventually benefit, but we must be precise regarding the timeline. If autonomous fleets achieve high utilization and fundamentally lower the fully loaded cost per ride, competition should put downward pressure on fares. However, that is an economic possibility, not an immediate guarantee.
Consumers will only see lower fares if fleet utilization outpaces the heavy hardware costs.
Early robotaxi systems require expensive sensors, redundant computing hardware, massive physical fleet infrastructure, commercial insurance, remote support centers, and high financing costs.
The labor savings generated by removing the human driver can easily be consumed by those heavy capital costs long before a passenger ever sees a cheaper price on the app.
And the timeline for the human drivers faces the exact opposite pressure. Human driving will remain economically relevant for years in markets where autonomous deployment is restricted by regulators, remains too expensive, or struggles with complex geography.
The displacement of labor will be geographic rather than universal. It will start in dense, high-demand, highly mapped zones first, before moving to more difficult, lower-density markets later.
Which is precisely why institutional investors tracking this sector should dismiss the noise of splashy partnership announcements and focus strictly on operational metrics.
The data points that actually matter.
The completed pay tricks, the scale of commercial cities, the specific vehicle ownership structures. We need to track the total fleet capital Uber is forced to support on its own balance sheet. We must measure idle time versus passenger time. And ultimately, we have to determine whether Uber's residual economics on an autonomous ride can actually improve without the continuous injection of balance sheet capital.
We can concisely summarize the divergent paths from here. The bull case for Uber is powerful. Uber uses the cash generated from its human-driven network to seed several competing autonomous ecosystems.
Autonomous vehicle companies gain demand without the expense of building consumer marketplaces.
Fleet utilization rises. Human drivers continue providing flexible overflow capacity where autonomous fleets cannot economically serve the peak demand.
No single autonomous provider controls the supply side. Uber retains the rider relationship.
In that outcome, the company successfully evolves from a ride-hailing app into the underlying operating system for urban transportation. The car changes. The driver changes. But the platform survives.
The bear case rests entirely on supply chain control. The premium, most capable autonomous companies scale their own independent fleets in the most profitable, high-density cities.
Consumers bypass the aggregator and develop direct, daily relationships with those specific autonomous brands.
Uber is left trapped, forced to finance alternative infrastructure and vehicle commitments, steadily losing bargaining power to the companies that actually own the scarce functional technology. Because human drivers remain necessary in lower-density suburbs, Uber ends up running two highly complicated supply systems simultaneously,
resulting in more capital required, more physical infrastructure, and zero margin expansion.
The decisive variable for the future of transportation is not simply whether robotaxis function technically. It is who controls utilization and demand once they do.
The automaker owns the physical vehicle. The autonomy company owns the digital driver. The fleet operator owns the physical asset.
And Uber wants to own the demand that makes all three of those layers economically productive. That is the essence of the $10 billion allocation.
Tell us which layer ultimately holds the strongest bargaining position. The company controlling the rider, the company controlling the vehicle, or the company controlling the autonomous driver? Subscribe to the Unlayered Global for more analysis of the business systems beneath technology and markets.
It comes down to control.
Uber spent its first decade proving a transportation company did not need to own the cars. Its next decade will require proving it can control autonomous transportation without owning the driver.